Hello and welcome back to Thematic Intelligence. At Global Data's Thematic Intelligence, we track over 100 tech, industry, ESG, and macro themes impacting all major sectors. I'm Carolina Pinto, and today I'd like to welcome back Rory Green, Head of China and Asia Research at TS Lombard. Rory, how are you?
I'm great, thanks, Carolina. Great to be back on the podcast.
It's great to have you. So the last few times that you were on the podcast last year, we talked a lot about China's sluggish economy. And by Chinese standards, China's economic growth has significantly slowed down in recent years. And this has been in part due to, the pandemic restrictions, the ongoing real estate debt crisis, and their issues with deflation. However, a couple of days ago, we saw China beat market expectations and grow at 5.3% in the first quarter of 2024. What can we take from this growth? Is China overcoming its debt issues, or is this growth kind of masking a bigger issue?
Yeah, good question. Because the Q1 data has been pretty solid and better than expected. There's basically two factors that are driving this. The first is a low base of comparison. So we're measuring a growth rate from Q1 this year to Q1 in 2023. And we have to think what happened early last year with China just emerging from COVID lockdown, still a lot of disruption in January and February. So that makes this year's data look better. And the other factor that has helped drive activity is government stimulus that started to come through to the economy late last year and really finally getting an impact at the beginning of this year to help stabilize activity. And this trend is probably going to be running through most of 2024, kind of weak stabilization around greater government stimulus to prop up the economy. But to your points of the kind of the bigger issues that China is facing, this kind of cyclical bit of stability is certainly masking a real weakness in terms of a long-term structural slowdown. And we touched on this a bit last year, Carolina. We talk about the 3Ds facing China: debt, decoupling, and demographics. And all those are pushing for weaker growth longer term. But for now, it's that government stimulus that is helping to drive a little bit of stability for China in Q1 and for the remainder of this year.
And I think now that we're on to the government stimulus in 2023, the Chinese government was pretty generous with the level of fiscal stimulus packages. And this was intended to obviously support the sluggish economic activity. But is this going to continue into 2024 and later?
Yeah, I think it's going to strengthen this year. So support last year was pretty good, as you said, particularly in the second half. But if we look back to sort of previous economic shocks, say 2008, 2015, which was sort of another property crisis in China, it was actually quite weak stimulus. And this really highlights one of the kind of longer term structural changes that is also happening within the politics of China. And that's basically that Xi Jinping realized the country's growth model has to change. They can't rely on pumping up stimulus particularly for property and infrastructure every time the economy slows. So this is quite a significant shift. And it basically means that Xi Jinping has a much higher pain threshold than previous Chinese leaders. He's willing to let the economy get a lot worse before he presses the panic button and starts to try and get things moving again. The other significant difference here is that the type of stimulus is also different. So last year, as you said, was more fiscal, and it was also really geared towards advanced manufacturing, whereas before it might have gone to property and infrastructure. This time around, it's gone from EVs to chips, state grid, clean energy, all these kind of new advanced manufacturing that China's betting on. So two big changes: higher pain tolerance and a different type of stimulus. And this year, we think that finally that pain tolerance has been hit. Xi Jinping is getting a bit worried, and we're going to see more of this new type of stimulus towards advanced manufacturing. And that's going to be really important for China's growth this year.
And I'm guessing that a bit of this pain that that they're feeling has to do with the deflation, the ongoing deflation issue. And unlike the rest of the world, China has been struggling with deflation over the last couple of years. And for the audience, what I mean by deflation is deflation occurs when there is a decrease in the price of goods, and this is reflected by weak domestic demand. Essentially, people aren't buying enough goods and services. But we see that this is still going on. And what is the Chinese government doing to address this consumer behavior? And is it working at all if this is still an ongoing issue?
Yeah, it's very much an ongoing issue, and I think one that's going to run for a couple of years as China goes through this difficult economic transition. You know, for us in the UK, or for clients that are listening, pretty much anywhere else in the world, lower prices doesn't sound that bad, but actually, as you say, it reflects very weak consumer demand, and also particularly weak industrial demand related to the property sector. So Chinese real estate is still by far the largest consumer of copper, glass, steel, cement, home appliances, you know, a whole range of commodities in the world. So you have the weak consumer demand side, the weak property demand side, they're interrelated. And then the supply of goods is actually even stronger. So some of that stimulus we just touched on that's going through to manufacturing is increasing the supply. So you have expanding supply, contracting demand, and you have this big deflationary backdrop. That's generally negative for China, but we should also say, Carolina, this is a very good thing for the rest of the world. If China was booming and was having high inflation, then the difficulty for the Fed, the Bank of England, the ECB would be much greater in trying to control inflation in developed markets. At the moment, Beijing isn't really doing a huge amount to try and get China out of deflation. There's a lot of levers they could pull through monetary, fiscal, supply side reform, a whole array of factors they could do. And the biggest one would just be to drive growth higher, to pump up activity. They're not really doing that. I think we will see a bit more stimulus this year and a bit more targeted things around, you know, upgrading consumer demand, consumer goods. But at the moment, it's quite a cautious response to this deflationary backdrop.
So there's no one and done solution.
No, unfortunately not. This is it's coming from a lot of the structural issues around the overbuilding of property, the negative wealth effects when everyone's put their household savings into these homes, and suddenly the price of those homes is dropping 10, 15, 20%. Overcapacity in certain industries. There's many things that need to be addressed before we get into a sort of a more positive inflationary outlook for China.
Yeah, I think that's fair enough. Moving a bit back to what you said earlier, that this year the government support is going to be more about the advanced industries, so the clean energy, the EVs, the semiconductors. A big driving factor of this investment is the ongoing China and US trade war. And this will definitely continue to affect the Chinese economy. But a big thing going on in the US is the US elections in November. So how are these looming elections impacting China's economy today?
Yeah, I mean, this is massive. Our China and wider Asia clients have been asking about the US election since last year. This is having a big impact already. Even before we get to the election, we can see it moving markets, changing trade before we even get anywhere close to an outcome. And the biggest impact is on the renminbi. When President Trump was in charge, we had the first China-US trade war that weakened the Chinese currency significantly. And now traders, market participants are having to price in probably about a 50% chance, more or less, that Trump will be re-elected and that he is going to resume that trade war with something like perhaps 60% tariff on all Chinese exports to the US. And that is one of the factors that is pushing the renminbi weaker already this year. And the closer we get to the election, the more that pressure is going to build up on the currency. So it's already having an impact, particularly in FX markets. Looking ahead to sort of beyond the election, in some ways it's not going to change too much around the long run trend of US-China relations. Trade and tech tension is only going to get higher regardless of who wins. But it's sort of how that friction manifests. And if it's Trump who wins, it's going to be sort of a sharp shock. Whereas Biden, it's going to be more of this consistent, steady ratcheting approach. So we'll wait and see. But in the meantime, the renminbi is already feeling the pain of this election.
Yeah, I think that makes a lot of sense. And so we've talked about the US, we've talked about deflation, we talked about the stimulus packages. So taking all of these factors into consideration, what kind of growth can we expect from China's economy for the rest of the year?
It's going to be okay. It's not collapsing, but it's not really going to be soaring higher. So calling it sort of a muddled year, a muddling through year. And as we kind of touched on, they're going through these big political economic transition, trying to set up a more sustainable growth model contingent on advanced manufacturing. That's very difficult. And at the same time they're doing that, they're battling these big structural headwinds, which are the 3Ds: debt, property-related, decoupling, US-China friction, and demographics. So big structural challenges, massive kind of political economic transition. And this means that there's a lot of underlying weakness. Part of that's going to be offset by greater government stimulus, but it's kind of a muddled approach, no collapse in activity, but generally kind of a weak stabilization for China this year. And that, I think, we should give two sort of key takeaways for the global economy. One is more trade friction. So weaker domestic demand in China, more money into advanced manufacturing. That's more export competition, more trade friction. The other key conclusion for the global economy, which is a positive one, disinflation. So China is, in effect, exporting some deflation or disinflation to the rest of the world. And that's going to make it a lot easier for the Fed, the Bank of England, the ECB to manage inflation rates in developed markets.
Well, that's good news for us. But thank you so much for coming back on the podcast. As usual, your insights have been really great. From us at Thematic Intelligence, thank you for listening and see you next time.